and welcome to Masters of Real Estate. Today I have a great guest for you, Joe Davis, that is an active investor, a flipper himself, and a private lender. So he has a unique experience investing in different types of assets, working with bringing resources to different investors in a lot of different ways. And I work with them quite a bit on the lending business as well. And so welcome, Joe. Appreciate you coming to the table today to talk about this stuff and teach some stuff to some of the audience members here. And I really love to dive deep into these topics because I have a passion for them on the lending side and the flipping and holding side and the investing side. But first, can you talk a little bit about your experience, what got you into real estate, what your experience was and what you were doing before real estate, and what made you kind of jump into this space?
Yeah, absolutely. Thanks for having me on. Yeah, historically, I've always wanted to get into real estate. I think everybody you meet in the grocery store or wherever you go, everyone's always saying, "I want to get into house flipping. I want to get into holding rentals," because I think most people have that knowledge that real estate is such a secure investment and it's where they want to be. But most people just don't get into it. So I was actually raised in the UK. But I was born in Texas, and I had a business in the UK, and it was acquired, and we came over here one summer with my wife, and we bought a couple little condos as an investment, and just kind of got hooked. And from there, just one thing led to another. Started flipping, started buying a few rentals, and then we started in 2017 we started a wholesale company, and from the wholesale company. We kind of organically got into lending through, just wanting to be able to offer our borrowers, financing on the products that we were selling them.
That's awesome. I call that real estate crack, those first two deals that you get hooked on it.
Yeah.
And you're like, oh, this is working. I bought a couple of houses. It really it gives you the confidence you need to continue to move forward. Even if you take losses and, take a hit sometimes on these things in the beginning. I mean, I know my profit was not as high as I thought it was going to be in my first couple of deals for sure. I think my very first deal, I bought a negative cash flow, brand new build property in Washington that,
Yeah.
did not, like I mentioned, did not cash flow. Was learning a ton, learned about snow removal and all this stuff that I had living from California, had no idea anything about. You go through those trials and tribulations and those pains initially, and you stuck with it. You continue to push forward. A lot of people, they realize, wow, I didn't want to be the flipper. I didn't want to be the actual person doing all the work. And I didn't want to be the person that, is doing the lending myself or, all the different things that go along with the trials and tribulations that you find out how hard it is after the fact. What made you stick
We
with
always
this?
tell
What
our
gave you that
investors
passion
that,
to stay with it? So go
yeah,
ahead.
we always tell them that first deal is kind of the make or break, because we see investors come in and they hit a home run on that first one and they're hooked, right? They think that every single deal is going to be a home run follow up
Yeah,
to that. Or on the flip side, they lose money and think that it's the worst thing in the world. So
right.
we always say it's important if you're going to do this, full time, to make sure that first deal is correct. And our first deal was not a home run by any means, but we got pretty lucky. We actually bought some condos, and then quickly learned later down the line about the HOAs and how it's pretty tough. But we were
Yeah,
able to rent those in a different kind of way. We actually rented them to a dental school who gave us guaranteed income, and we
interesting.
still have them today. So they're still pretty good. They still cash flow decently. Yeah, we've kind of been at every angle, on the flipping side and the holding side and the lending side, wholesale side.
It's funny you say that about the condos. I will not buy properties with HOAs anymore ever again.
No,
They
me
have all the
neither.
power in that relationship, and unless you want to be on the board yourself, a lot of them don't. A lot of the people that are on the boards don't have the right financial education. They make decisions that are not in your best interest necessarily, and especially if you're using it as a rental or something along those lines, it can be a giant headache. And that doesn't just
Hmm.
because there's an HOA in place doesn't mean that they know that they budgeted correctly for major repairs and stuff like that. And you could have CapEx or things not happening on the asset that drive that thing into the ground with the wrong management. So there's a lot of other
Yeah, we
factors that you don't have control over.
Yeah, for sure. We actually saw that in 2017, also after Harvey, how many of them were badly managed
Mhm.
because so much damage came in through Harvey that a lot of them just didn't have the money to make the repairs on the property. So it was a nightmare.
When you see those things, you realize very quickly that that the there are risks out there that you have unforeseen that are you're not sure about, right? And when you're
Hmm.
buying properties and flipping them, or you're doing, renovations on assets, or you're dealing with property management on a hold, or you're dealing with the acquisition funnels and the different parts of the sales process when you're buying properties at discount. There's so many things that can go wrong that you have to have
Hmm.
dialed in to do that correctly. Can you talk a little bit about your flipping experience on this side, and what you can kind of warn other investors about what to look for when you're flipping a house? What are the main risks that you see on those flips, that whether your own borrowers that are borrowing money from you or other
Hmm.
flippers can learn from, to do right or not do wrong? So
Yeah, for sure. We've experienced it all and we've seen it all. In terms of, I think the most important thing when it comes to flipping is having the right team in place, because you're not going to ever be able to do everything yourself. You need a really robust team. That comes down from having the right lender, having the right contractor. That's probably the biggest factor, and the majority of ones that we said go wrong was because the contractor wasn't prepped correctly for it, or their rehabs were over ambitious when they did the project. They were doing it just to get into the, just to get the job, and then during the process they increase their cost, and it just creates a whole issue. So on our standpoint, from the lending side, we get really into checking that the rehab is realistic. That's one thing. Making
mhm.
sure you have a good realtor who can kind of navigate through any difficulties when the property is listed. So yeah, I think having a really good team is my biggest suggestion. Um,
Yeah, I agree 100%. I mean, contractors are notorious for missing major items that they didn't see on their bid. They just give you a flat number or something like that, or they don't break
mhm.
things down, or they do break it down and they just miss that, oh, wow, we actually need all new windows on this property, or wow, there's a foundation issue that we didn't address, or we should have replaced the deck on the back, and it wasn't included in
Yeah,
the bid. And those overages, they, like you said, they do it to get the job, or they just don't understand, every little piece that goes in that interior, exterior, and other aspects that, major systems that really need to be looked at on every major thing. The cosmetic stuff can be overlooked, but, on minor items and things like that. But when it comes down to the big ticket items, that's really the ones you don't want to overlook, because that's what kills your whole deal and then causes major delays if you don't have excess cash reserves and stuff like that put aside. And like you said, I've seen some contractors that are in some project managers and investors that they've had great success through the whole rehab and everything, and they don't have a finalization approach to this to finish the little punch list items to make sure it's ready for
yep,
sale. That final transition seems to be very difficult for a lot of people to dial in, because it takes someone else outside going in that has the eye, and that is going to be the realtor a lot of the times, or an inspector, to come in and say, no, here's all the crap that your contractor missed, because every time there's a punch list, no matter who they are, and then if the realtor can't navigate those things and know what a correct final thing product needs to look like for the best sale, and they don't communicate correctly, your whole deal can get blown up too. It could sit there for months, and then you're
yep,
wondering why it's not selling, and they didn't tell you that, oh, there's still cockroaches on the ground in the living room or something because it's been sitting there for a month, or little things like that, or a bigger item that really should have been addressed up front that they just didn't communicate about. So
yeah,
it's
absolutely.
crazy when you see the things that they do. When you're dealing with this, outside of the renovation aspect of this, which is key, what are you seeing people run into on a valuation standpoint? We've had a lot of changes in the market. We've had interest rate fluctuations. We've seen changes depending on, of course, the state and the local areas that you're in, and street line issues, of course, where
Hmm.
one house is not comparable to another on a different street over, a block over. How do you kind of navigate those things when you're being a lender on that side, or when you're flipping a house yourself, to mitigate the risk there?
For sure, and I do think a lot of that comes down to being very market specific too. There's different markets which have taken more of a hit recently. We just lend in Texas, and most of our loans are in Houston, so we have a really good grasp of each little micro market within our market and kind of how the values have changed. There's markets here such as Galveston, which the appraisals can change, on a weekly or monthly basis.
Right.
So a lot of that, what I would really suggest is when when you're getting into the deal, you always, and it's, easier said than done, but you want to make sure that you're buying a good deal, a conservative deal. And a lot of that will also mitigate some of those issues that we talked about before with the rehab, because if you're buying it deep enough, it's going to give you a little bit more wiggle room when it comes to any mistakes that are made, any holding, any, contractor issues. If you have that kind of contingency in there, to be a little bit more forgiving than if you bought much higher. And it's difficult. It really depends on what you market in. Although we know the market here, it's still very competitive. So it's hard to find a deal which has a real juicy deal, which is going to kind of help those issues out. But yeah, I would say that's really the main factors when it comes to it.
Okay. And I find that, when people are analyzing these things, when you're dealing with
Mhm.
smaller price point properties, call it, 100 to $200,000 price points versus 400 to $500,000 price
Yep.
points, you get a little bit more wiggle room in the 500,000 or higher end price points on your renovation buffers. You can also have some more volatility in those higher price homes as well regarding pricing if the quality of the work is not done and things like that. So emulating
Correct.
and mirroring, exact quality and, workmanship on the higher end property that you see actually sell at a price quickly, is key. And looking at those time on the markets and that kind of stuff to see, hey, that comp took 30 days to sell, that comp took 2 weeks. What are the major differences? And, there's the major fluctuation price differences. Is that street different? Is it the
Hmm.
quality of work? Is it the age of the house? Is it the amenities that they put on this thing? What are the reasons? You got to think about this like an appraiser in
Yep.
that way to say, let me go take my value that I'm seeing as comps in that area, and let me make adjustments to adjust to your asset or my asset, call it, if I'm the flipper in that situation. And this is where I see a lot of flippers do wrong, right? I've
Yep.
flipped over 1,000 houses now, and I've learned 1,000 ways to lose money in a house, and of course, but I know how to make money on these things too. But looking at this, you start to see those little intricacies matter significantly. One has a pool, one doesn't. There should be an adjustment. An
Yeah, for
extra
sure.
half bath or an extra bedroom, there needs to be an adjustment, right?
Mhm.
Comparing apples to apples here and making those adjustments like an appraiser would, I think, is key. And as long as you have that quality dived in really, really, in depth and dialed in, I've seen a lot of this where it really comes down to quality. Like the lines on the paint are not perfect, or it's an older house and you're not going to make it as perfect as a brand new house unless you gut everything down to the studs and redo everything all over again. And a lot of
Mhm.
times that's not in the budget on that deal, right?
Yeah, and it's hard not to get emotionally attached to your project because you spend so much time and effort into it. That you go in there with the right intentions that, I'm going to competitively price this, when we're finished, but you spend 6 months and you have every time the flooring guy showed up late or your electrician, got tagged and had to pull the permit. That when you come to listing it, it's kind of human nature that you want to list it above to kind of recoup and make closer to what you originally thought. But we always tell borrowers that you can't help that. The two factors are you really have to do, in today's market especially, you have to do a very good product. You have to rehab it
Right.
very well. Like you're saying, everything is correct, and you have to price it aggressively. You can't be $20,000 over your best comp. It's just not reasonable in today's
Right.
market. So you have to kind of take that aside and put that on. And when it comes to the price point, um, we also like the ones where in the metric that you use, the days on market is a huge metric. I think that's one of the most important
Mm-hmm.
ones. But we also like to have alternative exits. Excuse me. So in some of those lower price ones, you can always, you know, um, kind of look at it as a DSCR refinance before you get into it to say,
Mm-hmm.
worst case scenario, if this thing did sit for a while and it's maybe a little bit of a lower price point, that we could quickly come in there and, hold it for a certain period of time until the market kind of readjusts. And then you can look at
I
selling
think
it at
that's
that point.
that's a huge point, and a lot of people don't look at this because what you have to look at everything from a risk mitigation standpoint. This is something we've done in the Midwest and the South, and where we buy
Mhm.
properties and hold them for rentals, is to be able to go through and say, hey, if our goal is to flip this, but what happens if I can't sell it? What happens if the bottom falls out of the market or something occurs? How can I hold this thing? And what is that cash flow return on investment going to look like on the capital that I have left in the deal? What if it goes down by 10% in the next 6 months because there's a market crash or something like that, and I need to refinance that? How much cash can I pull out of it? Can I bring in another joint venture investor to help supplement if I needed to and split profits with them? What are all the different ways you can exit this asset or stabilize it so that it's good long term, or taking that short term gain? And that's really, really key. And to be honest, I would much rather hold properties now than flip them. If I would have actually held all these 1,000 houses, I'd have like $50 million right now in profits from this stuff, because I look at the values when I bought them for in 2012, and I did hold a bunch of assets, but not 1,000 of these things, in any way. And so you look at that, because I thought I needed the money to do this, but people don't realize if they're flipping, a lot of times it makes more sense to hold. They just did a bunch of work to get it fully renovated and up and running. And if it makes sense from a cash flow perspective, a lot of times they think that, hey, I need the money to actually live off of. I need the cash. But you can build in a fee structure like a renovation management or acquisition fees and things like that, and partner with people to hold them long term on these assets too, and have a structure that way to where you actually are not paying taxes on all those gains and having to do that. You actually get tax benefits from holding and doing cost segregation studies and holding these things long term. So, and with the debt service coverage rates kind of going down recently, I think it's an interesting play to come in and do that aspect. It's not very fun for the brokers involved. Debt service coverage ratio loans are not very lucrative. You kind of do it as a favor for your flippers and things like that. So let's talk about those flippers really quick. And if a flipper is coming to you for capital, which is great to come into private lenders and private capital sources like yourself to be able to utilize funds for their flips, right? Sometimes they have the down payment, they just need the rest of it, and that's what they need. What's the best way to come to you? What's your ideal borrower here in this situation, and what do they need to bring to you from the loan side so that you can do an analysis on this and make the best decision, and they have the greatest likelihood of actually getting that loan from you?
Yeah, for sure. So we're really looking at two things. Most importantly, we're looking at the asset and seeing if it's something that we would like to lend on. Just by kind of giving it a bird's eye view and taking a look at the overall project, and again, kind of bringing in DSCR and what they could do on their exit. I think the ideal, ideal deal which comes across to us right now is something which was a little bit more cookie cutter. So it's got decent days on market. It could be a good rental property. It's not a $800,000 property that sits on a few acres with not a lot of comps.
Right.
So yeah, the asset's the most important, and then the borrower too. I think what we lean on most heavily is that the borrower's not going to get in a pickle if something goes wrong. So having the adequate liquidity in there to cover the debt service during the lifetime of that loan is important. And again, on these more cookie cutter houses, that debt service should, if they're evaluating the deal correctly and getting the deal correctly, it should be a lot less than that $800,000 house, right? So they're not sitting on that debt as long. But yeah, I think those are really the most key things, is looking at the asset itself and then looking at the borrower and see if they have the ability to soak up any time where it's vacant and you're doing the work.
Awesome. And what's your thoughts as far as experience goes with these borrowers? It's obviously harder to get financing, and interest rates are a little higher when you're dealing with borrowers that don't have a lot of experience. How have you mitigated the risk on lending to new borrowers, and how are they kind of treated from, I'll say, a experienced borrower in comparison on the loan side? Because I know you mentioned to me in the past a few instances where this is how we mitigate those risks when we're dealing with these new borrowers, and I think it's important to understand what you're doing there.
Yeah, so a lot of our original borrowers, when we came through, we knew them through the wholesale side of the business. We've sold them a ton of properties and seen the work that they produce, and it's quality work. And really what you find out is a lot of the good investors stay within the industry. They become repeat borrowers because they have a knack for it. And there's a certain characteristic that makes you a good flipper. Not everybody is designed to be a flipper.
Dealing with the ability to deal with problems. That's really what
Yeah,
it is.
exactly.
Grit.
And I don't care who you are. If you've done 100 flips or you've done one flip, you're gonna get some issue with that house. And some houses are just weird in the fact that they have more go wrong with them. It just seems like a consistent flow of problems, and some of them go a lot smoother. Having the
Right.
experience for sure helps. Having backgrounds and elements related to this, construction, real estate in general, that all plays a factor into it. But again, I think it also comes down to that team. If we were going to do a newer borrower, we would want to know a lot about who they're using to do the work. We would need to, have a little bit of their background and make sure that they have the right support. We've done it here before where we have new borrowers and we have contractors that we've used for 6 or 7 years that have flipped houses for us, flipped houses for other borrowers. We
Right.
might make an introduction there and tell them, we would prefer if we're going to do this that you use, these guys. But at the end of the day, really, we've seen borrowers with experience and seen new borrowers have issues that, have problems to
Couldn't deal with.
overcome.
Yeah.
So it does again come down to that deal that if they're buying, a really good deal, that there is some cushion and some ways to overcome those issues. And also the fact that if we track it correctly, we're not there to be overbearing and say, we're not going to give you money for the rehab, but we want to make sure that the project is going along correctly, and really just to kind of support them. So we're not coming in and saying, well, we're not going to do your draw because this baseboard wasn't completed. But we want to be
Right.
there to make sure that everything is on progress and help if there was an issue where you haven't requested a draw for 2 months or 3 months, and we notice that. Well, then we're going to get inside that property and say, is it that issue that you mentioned earlier? That nobody can come
Right.
in and kind of cross the T's and dot the I's and try to help them, overcome them.
I think it's key. And a lot of new borrowers have not had the experience of dealing with these problems, and they'll have more of an emotional reaction than someone that's dealt with these and says, okay, we just got to take this action to move forward.
Yep.
It becomes more methodical of, okay, next, how do we deal with that problem? Go to the next problem. Let's fix that. Let's fix that. And you kind of already have the direction of what needs to happen versus a new borrower may not know that. And they also may not understand too, hey, this is the way a contractor can screw me over. And this is the
Sure.
risks that I already have had to deal with that we need to mitigate in our process and procedures there, because and how do they know if a contractor is a good contractor or a realtor is a good realtor?
Mhm.
And so you stepping in and saying, no, hey, we got rehab teams for you. We have some realtors that are good team members. I'll only do this loan if you utilize them because I know their experience is what's going to make or break your deal, not really necessarily you if you have the proper cash reserves and stuff like that sitting aside. And I think, from that perspective, that's where the risk comes in on a new borrower is that inability to or lack of, I'll say, experience to handle those problems. And sometimes those new borrowers have a ton of experience handling problems from another business they run, and they've
Sure.
been through the ups and downs of a bunch of stuff, and have dealt with stuff. So it's not really necessarily representative of all new borrowers out there. It comes down to total experience across the board, and honestly,
Yeah.
grit coming down to how do you deal with this? How do you push through when you're in pain? And you've just taken a hit because your basement is now going to have a problem and cost you $40,000 on $100,000 budget, and you're 40% over budget or something like that. Now, how are you emotionally going to take that? Can you figure out how to make that deal work if you don't have the cash reserves? Are you going to be resourceful out there and find the money you need to make that happen? Is it going to break even, or are you going to have to refinance and hold it so that you don't take your losses on this thing, by selling it off the bat? Those different technical differences between a newer investor and an experienced investor is really what's going to make or break you long term on this. And if you have those team members in place to stop those issues up front, and you're, like you said, you're doing inspections on these to protect your investors involved, protect your capital when you're dealing with these loans on the lending side, that's the most important thing to say, am I in this property? Do I really see a vision of what's happening? I liken a private lender like yourself is to a flipper, because you're really managing the construction of this job to make sure it actually reaches completion even though you got other people that are supposed to be doing that part of it. You're still acting as the flipper yourself, kind of, and the property manager on the collection side and things like
Yeah.
that when you're dealing with, lending money on flips, even just as much as you are by flipping it yourself.
Yeah, absolutely. And I also think it helps a lot. Not that we're coming in to crush a deal, but to put as many eyes on a deal before it's funded. You know, every appraiser is not good at their job. Some appraisers
Yes.
come in and it's a terrible appraisal, and they're a licensed appraiser, and they're licensed with, Trek here. So having
Right.
as many eyes on every single aspect of your deal is really imperative. You've got a good lender who can really dive in when you send them your deal. You've got the appraiser. You've got your comps. If you have a good realtor who you're working with, they're putting eyes on it. So if you got 4 or 5 eyes on the value, that's gonna, play a role. And then also on the rehab side, right? Those are the two things that are really gonna crush you. So don't just pick the first contractor that you've had a recommendation from and get them to do the bid. You've got multiple contractors. You've got the lender coming in, checking your budget. Those are all ways that you can kind of help with some of the issues that might transpire throughout the project beforehand.
Yeah, I think having that proper due diligence process on your team is one of the most important things you can do when you're going through the
Yeah.
contractor due diligence and looking at, hey, do you have contracts in place for large jobs? Do you have insurance in place? What is your draw schedule? How detailed is your construction bid? Is it giving you that one number I talked about, or is it breaking it down into depth where you can see they were thinking about this, where they're doing a full walkthrough of this project and incorporating all the major systems into this thing? That's a lot different than the guy that is going to give you a number and say, hey, yeah, it's 80 grand. Thanks. And you're like, well, wait a minute. How did you incorporate this? Did you incorporate this? What kind of materials did you going to have? All of those little things add up, and when you understand the professionalism, you're going to pay more for the people that are fully put together. But a lot of times
Yeah.
it's going to be much more worth it because they're not going to be the ones that come back to you later for major draws and extras and overhead that they forgot about on their job. And sometimes these contractors underbid the job just to get to work, like you were mentioning. But at the same
Mhm.
time, sometimes they do it by accident and they just run out of money because these contractors necessarily are not necessarily great at budgeting in the first place. It's not their skill set. They're out there swinging hammers, dealing with the contract and the management of that construction work and everything, not back on a spreadsheet at home comparing Home Depot receipts with what they actually were budgeted and stuff like that over and over again, which really takes a higher level accounting skill set or CFO role to be monitoring those things within someone's business. And a lot of flippers don't have that experience either, which can make you run into trouble. You realize very quickly how important accounting is in a flip business or a hold business,
Mhm.
right?
Yeah.
So,
And a
um,
lot of these guys are making these decisions. They have such a short time frame to make these, right? Because the way that it's structured, you'll get a deal from a wholesaler. They tell you got to close in 7 or 8 days. It's there's not always a lot of time to say, let's get 3 contractors in there. Let's get four
yeah,
people in there to. So yeah, you really have to be prepped before you start to be able to do all these things and do
right.
the proper evaluations in the time frame that you're given within that specific deal.
That's super important because a lot of these, you're on your wholesale or purchase system. If you're buying from wholesalers, like you said, that short time period, you're not going to get 3 contractors in there every time to give you a bid. When 2 of them aren't going to get it every time, they're going to be pissed and they're going to stop going to these things, right? In
Yep.
addition to that, you need to be able to walk through that property yourself and get a general idea of what that renovation is going to be on the high side for you to
Mhm.
mitigate your risk every single time. So you as the flipper need to be able to go in there and know what materials are going to cost, what it's going to cost to redo a bathroom and a kitchen and the roof and the foundation issues and things like that because you've seen it in the past or you've mirrored or emulated other people or you have that right experience on your plate, and that will break a project because I see wholesalers trying to do this a lot of times, and they're like, "Yeah, it's 15 grand from a rehab." I'm like, "Yeah, maybe in 1996, but not now."
Yeah.
So, and now it's like 80 grand, 50 grand, 100 grand. These prices went up. Labor costs and materials costs are
Mhm.
shot through the roof with inflation, even over the last few years. And even if you have not done a flip or a deal in a few years, they're going to be shocked by the new prices that you're seeing right now on these renovations, which makes
Yeah,
you have to get even further of a discount, right?
if wholesaling ever gets regulated, then I always say that they have to at least flip one house. The wholesaler has to flip a house so
Yes,
that
that's
they get a better idea of what the costs are. Because really, that needle swings pretty quickly too. Because maybe the wholesaler's not necessarily trying to overinflate or fluff numbers to get the deal done, but if they're 10K off on their value and 10K off on their rehab, that 20K can swing the needle for how much cash to close that borrower needs and how much it eats into their liquidity pretty quickly. So yeah, it's really important that you don't rely on their numbers. I always tell people, if you want to look at a deal, you can use their numbers quickly to calculate, you know, how good of a deal they're presenting, but you're
yeah.
never going to rely on their numbers. You're going to have to still do your due diligence. But before you spend the time and effort to go out and drive 45 minutes to look at a property, make sure you have adequate pictures and you can kind of see if they're
Right.
being realistic on their budget, and also dig really deep into those values before before you go out there. And again, it's
I agree.
important of how you're getting your values. Don't just use some third party software that you bought and just kind of churns out a number. Have a really good system and team in place where you can get an accurate number before you waste the time to do it.
I think it's super important to be looking at every single comp that you're using as a comparable to your property, like I mentioned, and make those adjustments. But also, especially if there's times of market volatility or a potential down market or something like that, looking at 6-month-old comps is not going to be relative to where your property is going to be in another 6 months when you're finished with the rehab and ready to go on the market, or 3 months away with the smaller rehab, right? So you're going to go through and need to be predicting what value is going to be in 6 months from now, so you can be able to determine that. And so you're going to really need to be looking at pending listings and active and stuff that's on the market right now as well, if you're in a down market, to see what that looks like and see how long these are staying on the market, what's the trajectory of the market happening, because that 5% difference in price, if you're in a down market, you should be taking what you think the price is now and reducing it by 5% to mitigate your risk. And if the deal doesn't work, then don't do it. And same thing on the renovation side. If you think it's going to be a $50,000 renovation, you should be buffering that thing by 25% or so to make sure that you are okay, because things are going to come up. Timelines are going to take too long on things, and cities do cause problems. And there's a million reasons
I sure
why
do.
a rehab will take longer than you expect it to have. So,
Yeah,
and
we
and
always we always make sure they have a contingency. We always add a contingency to their budget. That's one
right,
thing that we require. But I would say be conservative on both sides, right? Be conservative on your value, be conservative on the rehab. The issue is that, especially with these newer borrowers, that they're just so eager to get into a deal that they evaluate 100 deals, and then eventually what their kind of mindset is, well, I'm just going to get into this deal because I need a deal. And
right.
that's kind of where you'll see that trouble, because they're just so eager. So a lot of it also comes down to your lead generation side of things. How are you being presented these deals? How is your deal flow looking? Do you have enough deals to evaluate? If you haven't
Right.
offered on at least 40 houses before you get that first one, which is the correct fit, then you're probably not in the right deal. If you're
Right.
on your second or third offer and you get your first house, it's probably not the right deal for you. So we'd say be
That
conservative on
emotional
both.
connection, you have to pay attention to the numbers, and the numbers will tell you everything. Take away the emotional aspect, because I think at one point we were spending $150,000 a year on direct mail, pay-by-click marketing, and things like that. And then you
Yeah.
got systems for that. You have call centers in place. You have people calling. You have someone on the ground that's got to get to that unit as fast as possible, and that costs a lot of money in overhead. And so if you don't have everything dialed in on that, then and
Mhm.
you're trying to get deals, you're going to try to squeeze numbers, and it's human nature to say, I think this one could work because I need it
Mhm.
to work, really
That's
badly.
that's
And
it.
that with
Yeah.
that need it to work mentality is what gets you in trouble. Instead of saying, no, I'm going to be conservative. I'm not doing that deal, because if it doesn't work in the first place and I lose money on that, I'm losing money on top of my marketing, on top, as well.
Yeah.
And so having that emotional disconnect when you're flipping is important. And it goes for the same thing for the lenders, right? All this information you're sharing here is just as important for the lenders that are lending capital on these projects as well, to be able to understand how to mitigate the risk on any flip, because a lot of lenders don't have that experience as well to understand. And I've seen a lot of lenders, usually the bigger lenders, not providing the same level of support for a borrower like you guys do, where you're really out there trying to help them succeed and going to the ground and seeing what's happening. And a lot of the bigger lenders like, nope, you screwed up, you're out, I'm foreclosing, and there's no personal relationship, versus someone like yourself with a flipping experience coming in, being able to say, no, hey, this is how we fix this. Maybe bring some resources in to help with this situation and solve the problem, so that it doesn't become a headache long term, because you become a problem solver as a lender as well, and you got to have those tools in your tool belt.
Yeah, absolutely. You want a lender to be part of that team that you need.
Right.
And sometimes it's tempting to just go for the best rate, or the the lowest interest rate, or the lowest origination points to some of these national guys. But yeah, like you said, there's going to be no support there.
Right.
And there's going to be times, even if you flip a lot of houses, there's going to be times where you have a problem house that you have to figure out a way to get out of it. And it might take some kind of restructuring. It might take, there's going to be something at some point that you have to fix. So yeah, if you can have somebody that has your back, and
we had a house in Missouri that we bought it, renovated it, went to go get the occupancy inspection. They said, oh no, it was vacant for 3 months, therefore it's not grandfathered in as residential anymore, it's now commercial. But you can get it back to residential if you get rid of the sump pump and connect to city sewer. And we're like, okay, well, how much is that going to cost? And we realized that in order to do that, there was a military base next door, and we couldn't shut down the street to get to city sewer, because the city sewer was across like a 4 or 5 lane street and down the block 5 houses to actually connect to that city sewer. And so we had to burrow underneath the street. One vendor in all of Missouri that we found to be able to do this, burrow under the street and literally dig 5 houses down, massive amount of money. This house was $120,000 house, right? Cost us like $40,000 in payment on this. We're like, well, I guess we're holding this one. This is years into our experience, but it's like something that just comes up that you're like, oh man, I can't believe this occurred, right? And we found out that the seller already knew about it, of course, and didn't say it. But then we'd have to sue them to go back to them. It's never makes sense to sue somebody. It just costs more money and headache than it's ever worth. At the end of the day, these are the things that can happen that, you're like, Usa, let me meditate for a minute and relax, because this is, a big hit to take, right? When you take some hit like that, but realize that's part of your education and your learning curve that you're paying for in that arena. So,
and it's
Joe, this has been awesome, man.
Some of those guys to walk away. We have another little story kind of similar to that too. Houston has some flooding problems, and there's a couple areas and jurisdictions that after 2017 they actually required the homeowners to lift the property. So if you were in the AE flood zone, you had to lift it, 14 inches above the firm baseline.
I've seen that.
Yeah, and so we actually, wholesalers were selling houses, and we actually came across one in particular where they had come in and they had done an amazing job. They rehabbed the entire house and made it beautiful. And then as they listed it, the city came by and tagged them and said, oh, no power. You can't get utilities because we're not going to permit it, because you have to lift it, according to, there's some little, nuances there. But I mean, the house to lift it was going to be $70,000-$80,000 to raise it.
And then you're going to have major settling issues, and the whole rehab is going to have to be redone because of that stuff too.
Yeah,
because you're going to have cracks in the walls. Oh man, that is
the amount of wholesalers
brutal.
I saw putting deals out within these areas during that time, with absolutely no knowledge that the cities were, making them lift these properties was absurd. So a lot of people got burned.
Yeah, just for everybody out there, there's pain in this space. Don't do it. No, I'm just kidding. No, it's actually one of the best things that you can do for yourself, is to find ways of making money in real estate in different ways. You actually don't have to actually be the flipper yourself. You can invest passively in other people's deals also. And when you're a lender like Joe and have the experience like this to back it up on the flipping side, you have a valuable skill set that's going to be with you for the rest of your life. You can make massive amounts of money on. And so realize you're building your education, you're building your ability to create cash flow streams that are going to pay you one way or another for the rest of your life. So, so Joe, this has been an awesome discussion. I really like getting in the nitty gritty of this. It's going to
Yeah,
help your
absolutely.
borrowers a lot with being able to, be able to do this correctly and make sure they don't make mistakes, and also help your capital sources like myself and the different investors and capital that you deal with to be able to mitigate that risk and know that you know what the heck you're doing to be able to help with that. So I
Yeah,
commend you
absolutely.
for the
And it's not,
education across the board, man.
it's definitely not all doom and gloom. The guys who come in,
Yeah.
they do really well, and they enjoy the process. They see the life cycle of that house from when they bought it to being, rehabbed and sold, and have an absolutely great time doing it. And I think it just all comes back down to what everything we've been talking about is the due diligence. So if the borrower I just mentioned had done due diligence, then they would have avoided that problem. So I think that's the biggest thing.
Absolutely. And, realizing, both of us flipped a lot of houses. And even though we've been through pain on those houses, we both do it again because it's the
Yeah,
amount
we're
of
still
learning that
here.
was worth it every time. So, and how do people get a hold of you, Joe, if they want to get a hold of you in the future for deals or for flips or for holds or for, lending for their own
Yeah,
flips?
absolutely. We always love talking real estate, so they can email me and we can jump on a call, or they can visit the website, which is just sparklending.com.
Sparklending.com. Awesome. Well,
Yep.
thank you guys. Thank you very much, man. I appreciate it. If people want to get a hold of me, they can go to my website at MathewOwens.com. We have lots of tools and stuff like that on there, quick analysis sheets, due diligence checklists, master classes. And I know, Joe, you have some different stuff on your site for people too as well. You want to tell people a little bit about that?
Yeah, sure. So we have some tools on there. We're actually adding some others. We have ways to calculate your out of pocket on your costs. Now, not every lender is going to structure, how they do their lending exactly the same as we are, but there's some functionalities on there you can check. And I think it's important when you're evaluating your deal to know, how much liquidity roughly you're going to need, what's your out of pocket, what's your monthly payments going to be. We're also building a pretty robust flip profit calculator. It allows you to put all your numbers in there and kind of give you an idea what you should make. And I think that having all of that is really useful before you actually contract that deal. Oh,
Absolutely. Well, thanks.
and also on the DSCR side, we're putting a lot into being able to evaluate your deal and know what your DSCR ratio is and how most of these lenders look at it before you get involved if you're going to hold that deal.
That's super important especially for your risk mitigation up front for your alternative exit strategy. So I highly recommend
Mhm.
everybody go and get those tools on Joe's site and stuff. And, if you need any tools on my site as well, feel free to reach out. So sparklending.com and MathewOwens.com. And I look forward to talking with you soon. And thanks so much, Joe. Really appreciate the time
Awesome.
today on the call.
Yeah, thanks, guys. Appreciate it.
Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. Three of the key pillars to becoming a successful real estate investor. Number two, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.